Welcome to the Power of Passive Income and How to Retire Rich with your host, Vijay Patel. Get your financial advice straight from the experts and learn how to take your first steps towards financial freedom. If you're ready to retire rich, then listen up.
So good morning, everyone. We have Reggie in the house. And as you know, the story of the podcast is Power of Passive Investing and helping like everybody retire rich kind of thing. But so we have Reggie today, and like we have an incredible story to be told by himself. And we want to definitely have some learning lessons that how did he transition himself from W2 being a self-employed, doing real estate, doing multifamily, and making a transition in a way where he is independent, happy, and able to support his family and not being trapped in a rat race of a W2 where there's never ending, paying bills kind of thing. So Reggie, if you can just, take the stage and introduce yourself, and we can move forward.
Sure. Thank you, Vijay, and thank you for having me. I'm excited to be here. So my name is Reggie Ross. I started off as a chemical engineer in the oil and gas industry. Spent a vast majority of my career there, mainly in corporate sales. Spent a little time on the technical side and touched all the major business functions during my tenure. Now, kind of in parallel, I slowly started getting into real estate through flips. I turned my primary residence into a rental and moved into a condo, and that was the beginning of the experiment. And I started very slow. I started a long time ago, but I would like to think that my growth curve is exponential. I've done a lot just in the past few years. So I started off with single family, accumulated a sizable portfolio, and then I liquidated my single families and transitioned into multifamily and haven't looked back. The economies of scale, just all the benefits that come along with multifamily just appealed to me. It's where I always wanted to be. It just made sense to me for a lot of reasons. And so in the past several years, I've linked up with two partners, and we basically, right now, we use private equity to raise capital and purchase, operate, and value add properties in the Southeast markets.
Understand. So what was the thinking behind moving from W to being a self-employed? Because that's where people get stuck, is fear, right? So what was the mental process and mental thinking that, okay, I don't want to be doing like on a W2, and I want to be financially independent for me, for my family. So what was the thinking process? Just walk us through that.
Well, I think at one time or another, I think everybody has had the thought that, yeah, I would like to have more money, and so I don't have to clock in and out, or you don't have to be constrained by policies and things that your employer imposes on you. And really, to me, it was family. It was a pretty personal reason, actually. So I had a daughter when I was very young. And I missed a lot of her childhood because I was going to college, I was working. And, looking back, I missed out on some really important times in her life because I was, trying to do the right thing and establish a career. And, looking back, or I guess looking forward, should I say, I want to spend more time with my family, and I don't want to spend it traveling all the time. I don't want to spend it, in a 9-to-5, and oil and gas industry. It's not just 9-to-5. It's a lot of times it's 24/7. And so those are just a few of the reasons that I chose to take this path. And I never knew it was possible. It always seemed so out of reach, but I realized after forming some partnerships and having discussions with other folks like yourself that it's very possible.
Great. So the second question is, and I think everybody wants to know, is how did you scale yourself from 0 to 1,000 door in really short time? So just walk us through that process.
Well, early on with single family, I kind of piecemealed properties together. I might have done, I did a burr here and there. I'd buy, renovate, rent it out, do the cash out refinance, and kind of just repeat the process. And that's more of a linear approach. And then so I got into buying portfolios of single family homes, and that was really my first experience with raising investor capital. And that was an interesting process because that doesn't come natural to me. The capital raising process, I had to change the way that I thought, because now I realize that it's not asking people for money; you're providing them an opportunity to make money, and that's really what it's about. And so on that first go around, I actually structured a lot of the investment as debt as opposed to equity. And so I was able to retain 100% of the ownership in the single family portfolio. So once I did that and accumulated more, I eventually just kind of liquidated everything and rolled it into multifamily. But yeah, that was kind of that was the step. I think there, just kind of seeing the economies of scale of multifamily.
Got it. So can you share some of your investor stories? How did change their life by investing passively in your deals? Because this is the show all about passive investing and like trying to spread the word that, okay, even if you don't have time, you can still invest passively and be part of the deal. It's not like, oh, somebody's just trying to take your money away, but you can literally be part of the deal, get to know the guys, and at least get to know the process too, and maybe you can jump up the ladder.
Well, some of the first couple of deals that I did that involved outside capital, I really had to give away a lot, or I had to offer very attractive terms to attract the investor capital because of my lack of experience managing investor capital. And I was very willing to do that. I know that sometimes you have to put in that work to establish a reputation, and I was happy to do so. And it worked out well. I think some of the folks that I worked with early on were very happy in the deals that we took full cycle. So far we've been able to meet all of our investor expectations, and no deal ever goes to plan. But the deals that we have taken full cycle, like for instance, we took one to market last year and sold it several years earlier than we had actually planned. But we kind of saw what was happening on the horizon in the debt markets, and we had already executed the value add plan, and so we decided to harvest profits. And so that was just an example of where we were able to outperform from an IRR perspective and a cash on cash perspective, even though we sold it a little bit earlier. So the trade-off there was that everybody had to deal with the recapture on the depreciation a little bit earlier than anticipated. But I think all in all, when you factor in the time value of money, it made sense.
Got it. So right now, there's a lot of cloud around real estate market, like, interest rates are fluctuating, economy is slowing down. So how do you yourself positioning, and what do you think about in general real estate? Is it still good investment?
It's always going to be a good investment. Now I say that generally speaking. Of course, there's markets that you might want to avoid at certain times. Maybe there's certain asset classes that aren't going to perform well in the near term. But there's an old saying that you make most of your money when you buy, not when you sell, and I think that's going to be very true. So while I continue to be bullish on multifamily, the number of deals that are making sense, we're just not going to see a whole lot of it. So obviously, I think I don't think cap rates are going to go up too much. I think we may just see a stagnation over the next couple of years. I mean, even with what's gone on in the past 2 years, they've remained pretty sticky. So people always need a place to live, and if you look at the population growth in the U.S., it's going to continue to go up. We've already got a shortage of housing. Right now, staring down the barrel of a recession, home ownership is going to go down, and that means there's going to be more renters in the market. And so, while there's some headwinds out there, I think overall it's still going to be a good inflation hedge, and if I just think about it in the most simplistic terms, there's a finite amount of land on Earth, and there's an ever increasing population, and they're going to need places to live.
Got it. So, what do you think about the other asset class? Because there's a lot of noise about multifamily, but what about the other asset class? And like, how do you invest? If you do, then let's discuss about that.
I still consider single family from time to time, but more on a flip basis. It's quick cash. Sometimes the returns can be very attractive, depending on where you buy at. I'm not a huge fan of single family anymore because of the administrative burden. With multifamilies, you can buy 100 units and you have one loan, one insurance payment, one property tax payment, et cetera. And if you want 100 single family homes, you have 100 bills for each line item, and it can get cumbersome. And so I think, one of the benefits of multifamily is that you're not necessarily at the mercy of the local comps. You can, through value, strategic value add projects, you can increase the value of your property. Now, there's still the cap rate conversation to have, but you have a lot more control. And with single family, I think we're going to still see some contraction in home prices. And so if people are looking for appreciation plays, and even flippers, I think they're going to start to see margins kind of thin out. I think only time will tell. It's really going to depend on if we get that soft landing that the Fed wants, which with the tight labor market, we could see that. But we'll see.
So what type of returns you try to give out on your investors? So like being a passive investor, there's people try to distribute quarterly, people try to distribute even monthly basis. So what type of, structure you try to do, keeping your passive investors in mind? How do you make them happy?
So just at a high level, we typically try to structure, or we try to find investments that can support anywhere from a 6% to a 10% pref. And then we like to see at least a 2x multiple at a 5-year exit. Now, I've become a very big fan of a perpetuity model that we stumbled upon through some JV partners. And basically it involves, finding properties that you can refinance out 100% of the member capital within 2 to 3 years of purchase. So you get a pref those first 2 or 3 years, and then at the end of, say, year 3, you get 100% of your original investment back, and then you share in the cash flow from then on out. And so, we intend to hold a lot of these, as long as we can. So we say perpetuity, but that could mean 20, 30 years or more. Mm-hmm. Since this is a generational wealth play for a lot of us, and we're trying to build a legacy for our families, it's something I'd like to pass down to my children. So we keep the long-term perspective on our acquisitions. Now, that a lot of times that means we pass up on really good deals that may check the box for a 5-year turn and burn. But since we're looking long-term, that's where we kind of keep our focus in multifamily.
Got it. So let's say if an investor is watching this video and try to invest in your deal, what type of numbers you try to deliver? You mentioned about typically you try to do 5-year cycle, or is it less? And what type of properties you go after, and what's your thinking behind acquiring the properties?
Sure. So some of our early projects were planned 5-year projects. The one that I mentioned earlier, we actually took it to market about 18 months after purchase. We had finished the value add plan, had questions about the upcoming state of the economy, and so we were able to dispose of it and provide solid returns for everybody. Now, everything else that we have right now, we have one property that we will end up holding for about 5 years, and then we'll sell. But everything else that we have, we plan to hold indefinitely. So typically, if we're talking cash on cash, we typically strive for that magic, 8 to 12%. If we can get more, great. And then if I think about IRR, We typically try to look for anything above 15. And that's we try to underwrite based on reality. Sometimes I see some wild rent projections. I may see unrealistic numbers on certain line items. I might even see mistakes. Like some municipalities, for instance, they assess property taxes in arrears, and so that means you may not see an increase for a year or two, but when you see it, it's going to be significant. And sometimes that's not built into the numbers. And so those are the types of details we try to dive into to make sure that our pro forma isn't just solid in year one. It's as solid as it can be with the uncertainty around it, through the life cycle of the project.
Got it. So like a lot of people just talk about success, but we also want to talk about like failures. Everybody has their fair share of failure, but we learn from it and, like we improve ourselves. So if you can please share some of that learning, we would appreciate.
Sure. That was, I think I alluded to this when we were talking before the podcast started, but I had a lot of learnings early on. When I turned my primary residence into a rental, I thought because I was getting more rent than my mortgage payment that I was making money. And that's as deep as I thought about it. And, I realized that was really only the tip of the iceberg. And so, some of my early learnings, I would say I probably still made money on that first rental. But I made so many mistakes. I chose the wrong property management. The way there's just so many things that I did wrong or just wasn't aware of. And so that was one of the reasons that I stayed solo for so long, because I wanted to get a lot of those mistakes out of the way. And I'm a firm believer that you got to fail. Because that's where you learn. In the engineering world, if you talk to two engineers that both work on the same area, if somebody has a lot of problems in their career, they're going to learn a lot more than the guy whose projects always went
yes,
without a hitch. So that's how I think about failure.
It's all about like problem solving, like especially like what you learn from failure is a problem solving better than somebody else's. Like if your life is smooth, you don't know the problem solving, right? Like the right way of doing, but you don't know what if the problem, like if things go south. And at every point of any business, like no matter if it is real estate, I don't know, engineering or even healthcare, doctors, there's always ups and downs. If there's something, a new regulation or new things that will, can change industry entire overnight. So, but let's discuss about one thing is like, there's a lot of people out there trying to be a syndicator, right? So as a passive investor, what are the qualities they should look for if they're trying to invest in a deal, or how can they make sure that their money is secured?
Well, so, I mentioned reputation earlier and experience. When I first got started, that was the biggest barrier to entry. We had a lot of interested parties, a lot of phone calls. But when it got down to, how many deals have you done like this? And the answer was 0. That usually eliminated a lot of potential prospects. And so, early on, we had to take a lot less equity and, provide higher returns in exchange for the confidence. But slowly over time, if you act as if you approach multifamily like you're a fiduciary with your investor's best interest in mind, I don't think you can go wrong. And it's always putting them before yourself. And that's one of the reasons that we always invest in our own deals, so that our investors know that, hey, we have skin in the game too, and we believe in this deal so much that we're putting our own capital into it.
Yeah. I think one thing that every investor I think likes is a skin in the game. Like if you are taking my money, like are you investing yours, right? Because if it's like your mouth is where you are saying, right, kind of thing. So like I think I truly believe in that too. Is people like to see some skin in the game. I have closed so many deals just based on that. The first question is, are you investing in the deal? And the question will usually come from like some experienced investors. The first question, or some older people, because they have so much of experience that this will be the first question they will ask is, are you investing in this like property? If the answer is yes, then let's talk. Otherwise, don't even talk. That's it. Conversation is over, kind of thing. So yeah, I think I would like definitely relate that is like sincerity, I would say. Your investor has to see like sincerity of like your work, how serious you are about your money and the work that you're doing. Do you know your work? Like, do you know your numbers? A lot of syndicators are out there like inflating the numbers, like hyperinflating the numbers, right? So like true investors will know these differences, but somebody starting out might not know. So I think a background check, a history would help at least to weed that. And then, like as you invest, we can definitely, like it's kind of getting pro at every point, like whether it's you're doing it in a management side or you're doing investment side, then you know that, okay, like, this is the market. If this is the property, yeah, it makes sense, kind of thing.
Yeah, and a lot of times you can look at the incentives for the GPs in a deal and kind of get a sense of where their priorities are. And for instance, and this, I'm not knocking anybody else's business model when I say this, by the way. But the way that we structure most of our deals is we don't really make a lot of money up front. We don't take large acquisition fees. We don't nickel and dime investors for every little milestone. We basically don't even get paid very much until they get all of their original investment back. And so we kind of think of it as, the pot of the gold at the end of the rainbow.
Yeah.
And so, if you look at a deal and they've got a 5% acquisition fee and, a 10% asset management fee, and I'm being dramatic, but, if you see some exorbitant fees on there, and, maybe that's a red flag. But I think you have to take the overall investment picture into account. If it's going to be a very heavy lift, maybe a higher asset management fee is valid. And so, that's just where the critical thinking comes in. But, for investors, there's a lot of things you can look out for, but thankfully we have the internet nowadays, and it's made the world a much smaller place. So sometimes just with a quick, keystroke, you can find out a lot more than you used to. And, you can look up LLC records on the Secretary of State website. You can look up property tax records. So many public records you can use to validate the information. And that's what it's about. You want to be able to trust your sponsor, but you should also be able to verify what they're saying too.
Yeah. And I think like what you mentioned, one key point is the management fees and other fees that people try to. So like when they are trying to attract investors, they are throwing out like, OM left and right, but OM has all the projections. I have yet to see a OM which is clearly like stating, okay, this is going to be the management fees, and this. Usually they talk about performance on OMs, right, and try to attract it. So if there is a more transparency around management fees and operation fees, I think that would be highly appreciated from the investor point of view. Like from a lot of guys, like not just performa. Of course, performa is important, but is a dollar save is dollar earn. So if somebody's losing 10% on a management fee, that is the money that is gone from investor side that could be used for cash flow, right? So
sure.
Yeah, like I see like a lot of backdooring just based on that. Like people just try to jack up the management fees and like other miscellaneous kind of fees. They try to come up with the different words from institutional investors kind of thing. But as an individual, I would say like just try to stay away from institutional process, because their game is totally different. They don't care about investors. As we were talking about BlackRock, right? They just stopped distribution, but they will still have funding that individual real estate investors cannot afford.
All right.
So what about RV parks that you mentioned? Let's just talk about that for a few minutes and we can, I think, conclude.
Okay. As a group, we have some operational experience. One of the partners owns a 50-pad RV park in Florida. And we recently closed on a 106-pad RV resort development in South Mississippi. And this one was positioned very uniquely. We were actually looking at a completely different piece of property, and we were calling the different parks around, conducting the market analyses. Hey, what's your occupancy? What are you charging per night, per week, per month? Do you rent by the month or by the week? And all of those types of things. We were collecting data, and we came across a gentleman, and he said, "Well, I'm booked up for 3 months, but I was going to build this RV resort down the road, and I'll sell you that property." And we went and looked at it, and turns out after Hurricane Katrina back in 2005, I think, it was a FEMA trailer park. FEMA set up trailers for people who had been displaced from their homes. And so there were sewer lines, water lines, power poles already ran, roads were already there. It basically had all infrastructure in place. And so really all we had to do was put a few buildings, give the place a facelift, and put pads down. And the market and the area, it's very short supply. Within about a 30-mile radius, there's basically no occupancy, and so it was kind of a no-brainer for us. But we closed I think on the 15th of this month, and we've got all the entitlements complete. We've already started work on site, so it's exciting. We're looking forward to it, and we're a fan of this asset class, by the way, because it has very low overhead. With multifamily, the old rule of thumb is the 50% operating expense ratio. At least that's where you start anyway. And with RV resorts, it's closer to 25 to 40%, depending on how high end you go. So we like that. We like that it's not as capital intensive as some of the other asset classes.
Got it. I think we'll just open up a Q&A for a few minutes, and then we go from there. So Sherry and Matt, if you have any questions, we can take that, or we can conclude.
I'm good, actually. I've enjoyed this.
Oh, thank you. Thank you so much for your time. So I think it's a good time to conclude, and we can definitely, continue this talk. It was nice really meeting you, Reggie. Was nice knowing you in person. I know we know each other through social media. As you said, the world is very small. I get a lot of DMs from a lot of people that, just through social media. And I think, as long as you use it in a good way, it's a very good platform to meet new kind of people, which was not possible a couple of years ago, right? So thank you so much for everyone that is joining, and we'll meet next week. And we'll be in touch. Thank you so much.
Thank you, VJ. I appreciate it.
Yes.